Hey, how's it going everyone? It's Griffin here, and in today's video we're going to be revisiting Canada's favorite investment account, being the TFSA, which is short for tax-free savings account. We'll start off with a quick refresher on the account and how it works, followed with what new contribution room we're looking at in 2022, and then finally we'll be covering 5 key mistakes that you want to make sure to avoid in 2022 to take full advantage of this fantastic investment account. Alright, so the tax-free savings account was first introduced in 2009, and this is a registered Canadian investment account. And the registered part basically just means that A, it offers some tax sheltering capabilities, and then B, it is also monitored and regulated by the CRA, which is the Canada Revenue Agency. The goal of the TFSA is to allow Canadians to both save and invest up to a certain contribution limit each calendar year, where those funds can then grow tax-free in the markets, and any other interest or dividend income that's incurred within the tax-free savings account on your holdings is also not going to be subject to taxation in any form when come time to withdraw those funds later on down the road. And this is definitely beneficial when it comes to fully benefiting from the effects of compound interest, because taxes can really dig into investment returns. So if you're able to take advantage of compounding growth over 10, 20, 30 years even on a tax-free basis, that's massive. Now, of course, there are limits on how much you can contribute to your TFSA each calendar year, and this is an amount that's set by the Canadian government. So in recent years, it has been $6,000 per year, and as we can see from this chart right here, it's varied between $5,000 a year on the lower end and all the way up to $10,000 in 2015. Since 2019, though, it's been around $6,000 a year, and you'll notice that the right column is also titled Total Contribution Room. This is because contributions towards a TFSA are cumulative from the year that you turn 18 years of age. So based on this reality, if you were 18 years old before 2009 when this account was first introduced, well, you would have that full contribution room waiting for you, which as of 2022, with that new $6,000 worth of contribution room, would equate to $81,500 that you can choose to contribute even in a lump sum if you wanted to. On the flip side though, if you turned 18, say in 2019, well, as of 2022, you would have $6,000 per 4 years, meaning you would have $24,000 of contribution room available to you as of 2022. Now, as a side note here, considering the amount of inflation that we've been seeing over the past year, it would be really great if the Canadian government would increase that TFSA contribution room next year, because $6,000, say in 2019, equates to around $6,400 in 2021 as it stands right now when I'm filming this video. So that's quite a loss of buying power when it comes to only a 4-year difference. So hopefully as of 2023 and beyond, it'll maybe increase to 6,500, maybe even 7,000, but that's just speculation, and hopefully we'll see that as Canadians. All right, a couple other things though about the TFSA before we jump into those 5 mistakes to avoid in 2022. First of all, the contributions towards a tax-free savings account are what we call post-tax, meaning in the calendar year, let's say you made $50,000, you're still going to have to pay taxes on your full $50,000 of full taxable income, and then your contributions are made after paying that income tax. So let's say you paid $15,000 in income tax, you have $35,000 left over, your contributions would be pulled out of that new $35,000. That is why it is called post-tax. On the flip side, this is in contrast to say the RRSP, which is the opposite, all right, where your contributions to your RRSP are what's called pre-tax, meaning if you made that $50,000 and you made a $5,000 contribution to your RRSP, your taxable income will actually be reduced by the amount of the contribution, in this case $5,000, so you would only pay income tax on $45,000. Hopefully that wasn't too complicated, but that's basically the main difference in terms of post versus pre-tax contributions. And in the case of a TFSA, they are post-tax contributions. So depending on your income level, this can really come into play regarding a tax strategy, and I would probably recommend talking to your accountant or CPA about this, but generally speaking, unless you're making a ton of money, it usually makes a lot more sense to start with your contributions towards your TFSA and maxing those out, because the power of compounded growth on a tax-free basis is massive. So yes, reducing your taxable income with RRSP contributions is also very beneficial in a tax strategy. I do this each year, or at least I try to max it out to lower my tax burden in the given year, but maxing out your contribution limits on the TFSA is going to be really beneficial for that tax-free growth over time. And we're going to be looking at an example shortly here. You'll see firsthand why that is. All right, now what's also nice about the tax-free savings account is the fact that you pretty much have full autonomy over your transfers in and out of of the account, and you're not going to be incurring any fees or penalties for doing so, in contrast to say the RRSP, where once you put that money in, other than a couple specific reasons, you can't really take those funds out until retirement. You will incur a fee and a penalty, whereas the tax-free savings account, other than a couple technicalities we'll be addressing later on in the video, you can pretty much take money out and put money in at your discretion up to, once again, that contribution limit. And this is really great because a TFSA offers a lot more flexibility for saving towards short-term as well as long-term goals, even retirement. So that is really something that I like about the tax-free savings account, that flexibility with your funds. And then finally, I've been asked this question quite often: can I have multiple TFSAs? And the answer is yes, you can have pretty much as many TFSAs as you want, even spread out across multiple different financial institutions. All you need to remember is that your contributions spread out across these accounts cannot exceed your total cumulative contribution room. All right, so now that we've had the chance to refamiliarize ourselves with the TFSA moving into 2022 here, let's now move on to the 5 key mistakes that you want to make sure to avoid with the tax-free savings account moving into the new year here. And by the way, if you need to open up a tax-free savings account yourself so you can take advantage of everything we just spoke about, make sure to check out the links down below. You can open up, say, a TFSA with Questrade and get $50 in free trades. Also, you can open up a TFSA with, well, Simple Trade and get $25 for free when you sign up and deposit $100 into the account. Pretty much just free money at this point. And also, this is a great time to speak about today's video sponsor. And it turns out there is no video sponsor for today's video, so I'm going to sponsor it myself. Make sure to check out the link down below to my full stock market investing course if you really want to start off 2022 on the right foot when it comes to your investments and your investing for the long term, where this course is going to teach you everything you need to know about investing in the stock market and building a portfolio suitable for your needs as an investor, also utilizing the tax-free savings account. So yeah, make sure to check out the link down below, and let's now get into the first mistake to avoid in the TFSA. So we'll actually be speaking about a couple of new mistakes to avoid here, and then also revisiting some past mistakes we covered in previous TFSA videos that needed a bit more explanation. Mistake number 1 is seeing a TFSA as a savings account. So even though the tax-free savings account has savings account in the name, it is far from a savings account. Rather, this is a full-fledged investment account that should be treated as an investment account, because you can purchase in it stocks, ETFs, and other financial securities that you cannot purchase and hold in a regular bank account or a high interest savings account. And the reason why I'm bringing this up is because in previous videos where I was speaking about tax-free savings accounts, I've had some viewers comment down below that, hey, my bank is offering, say, a 1.5 or 2% interest on holdings in my tax-free savings account. Is this good? Kind of alluding to the fact that they're viewing the TFSA as a savings account rather than what it truly is, being an investment account. And in reality, if you're new to investing and you're not super familiar with the TFSA, I can fully understand why this would be confusing. For example, if we go over on to EQ Bank's website on their TFSA specific page, well, it says that you can get 1.25% on the cash holdings within your tax-free savings account. So it's kind of confusing, right? Are you putting contributions towards a TFSA and then making interest, or are you going to be investing in the TFSA? But the short answer is that you shouldn't be viewing the TFSA as a savings account. You should really be looking at investing into exchange traded funds, for example, as well as other investments for that large long-term growth of your funds over time. And the reason for this is because saving taxes on, say, 1.25% interest that you're incurring on funds held within a TFSA is really not that significant in the big picture. It doesn't even beat inflation at this point on a yearly basis with what we're seeing right now, right? So with the TFSA, you want to make sure that you're at the very least taking advantage of market returns that are more in line with, well, the general market. So at the very least, 7-8% per year, and that's really going to be more significant for that compounded growth over, say, 15 years, and then fully benefiting from tax-free gains on those funds. And just to highlight how significant this difference really is, let's take a look at this compound interest calculator. So let's say you started with $0 and then you did a yearly addition of $6,000. That's probably going to increase over time, but for the sake of just highlighting this example, let's just put $6,000, which is the yearly limit right now for the TFSA. We'll put 1.25% on interest rate, and that is going to be compounded on a yearly basis for a time horizon, let's say of 30 years. Let's say that's what you stuck to, and of course that's not really realistic, but just to showcase this difference here. So the total value of your investment would be around $216,000 after 30 years of growth and $6,000 a year for total interest earned of just under $37,000. Now, if we looked at this exact same example, the only difference here is that we put an 8% average market return, which let's say the S&P 500 is usually right around 8% when you project this out over multiple years. We do that exact same calculation. Well, now we're looking at a total value of the investment of $680,000 for total interest earned of just under $500,000, which is a difference of around $470,000. Looking at 1.25% interest versus, say, at the very least market returns, that makes a huge difference over the long term. Okay, mistake number 2 here is investing in a tax-free savings account while you are still carrying debt, pretty much of any kind, but specifically consumer debt. And in reality, this applies to investing in general, not just the tax-free savings account. The reason why I'm mentioning this though is because I have had viewers in the past comment on some of my videos, well, hey, I am carrying some debt, but can I still invest in a tax-free savings account because I'm going to be growing those funds tax-free anyway, so could this be beneficial? And then also B, am I going to be able, especially in the market environment right now, to beat out that level of interest that I'm paying anyways? What I mean by this is, say you have debt that is incurring 5% interest. If you're able to create, let's say, 8% interest on your funds and your investments, well, you're making that 3% spread. And what I would say to this is really that I never recommend this for pretty much anyone. Reason being, there's a couple. First of all, returns in the stock market are never guaranteed, but interest you're going to be paying on your debt are 100% guaranteed. That's number one. Number two is the fact that right now, considering inflation as well, that's around, that 4, 5, 6% level that we have even seen in October. Well, you're not only going to have to create a higher return than what you're paying in interest on your debts, you're also going to have to factor in the inflation for your real rate of return. So let's say you have, again, 5% interest on one of your debts. Right now, let's say 5% inflation. You're looking at least 10% that you need to make in the stock market in order for your real rate of return to be higher than those two other factors combined. Hopefully that makes sense. But what you need to take out of this is that I pretty much never recommend investing at all while you're carrying consumer debt that has a rate of interest that's at least higher than 5%. That really makes no sense to me. Mistake number 3 here is not investing in certain US equities that you're interested in just because you want to save on the US withholding taxes. Believe it or not, this is actually something that I've been asked several times on the channel, and I've also seen multiple threads on the internet speaking about this exact topic. Restricting yourself from investing in the US stock market, which historically is one of the best stock markets to invest in for above average returns over, say, the Canadian market and certain international markets as well. Not investing in that market just because you are looking to save on withholding taxes really makes no sense at all. Without getting into full detail about how withholding taxes work, if you're more interested in that, make sure to check out, I'll leave a link to a video that I made last year speaking about this in full detail down in the description. But yeah, without getting into full detail, essentially the withholding taxes are 15% withheld by the IRS on dividends only from US stocks towards Canadian accounts, excluding the RRSP. So for example, if you hold shares of, say, Apple that does pay out dividends, that is an American company. If you hold shares of Apple in your TFSA, well, yeah, when they do pay out a dividend, 15% of the dividend only is going to be withheld at the source. So you're basically looking at 85% of the dividend yield for an American company if you're holding their stock in your tax-free savings account. But again, it's only on the dividend, and you're going to be taking full advantage of compounded growth on a tax-free basis of the actual capital itself, right? The capital gains in the account, regardless of whether or not they're Canadian companies or American companies or even American exchange traded funds, are still going to be fully tax-free. So again, if you're newer to investing, I can see why this would be confusing. And I've also seen some people being kind of overwhelmed, taking this really into account for their overall investment like strategy and how they're purchasing US stocks and stuff. I would just say that, first of all, you have nothing to do on your end for when it comes to withholding taxes. The IRS is going to withhold that 15% at the source, and you're left with 85% of those US dividends. Okay, moving into mistake number 4 here, it's kind of going to be 2 in 1. one. So the first part being not fully understanding how contributions work, but then also utilizing your contribution space in a proper and efficient tax planning strategy. So let's get into it first. The contributions are not all too complicated, right? We spoke about them at the beginning of the video. They are cumulative from the year that you turn 18 years of age. However, I have seen multiple people commenting, can I make contributions to the account? And then let's say something comes up, I want to take money out of the account, but then once I come into money again, recontribute back into the account. So let's speak about that right now. Basically, yes, your TFSA contributions are cumulative from the year that you turn 18, and you are allowed to put money in and take money out pretty much at your own discretion. However, this is going to impact your contribution room and your limit, I should say, in the calendar year in which you're making those contributions. So let's say, for example, in 2021, you turned 18 as of 2019, meaning you would have 3 years of contribution room available to you if you've never contributed at $6,000 per year for total cumulative contribution room of $18,000. All right, that's our baseline right there, $18,000. You decide to put $10,000 in your TFSA at the beginning of 2021, meaning you would then only have $8,000 left of contribution room that you can make in the calendar year. Okay, so fast forward to, let's say, October, housing boom, you decide that you want to purchase a house and you need that $10,000 back for a down payment on a home. So you take that $10,000 back. Now you have $0 in your TFSA, $10,000 in cash in your account. You purchased the house, great. Fast forward 1 month, you had a pay raise at work. Now you have a lot of money to work with and you want to reinvest in your TFSA. Well, you cannot invest your full $18,000 back into the TFSA. In fact, you would only be able to put $8,000 in because you've already made a $10,000 contribution in the year. If you wanted to put the full $18,000 back in, you would have to wait until the new calendar year rolls around, or then you would be able to recontribute the full $18,000, and you would also unlock the new contribution room. In this case, in 2022, it is $6,000. So come January 1st, 2021, you would be able to then put $24,000 of contribution room for your TFSA. Hopefully that example makes sense. And quickly here, since we're on this same topic, and this can be somewhat confusing, what ends up happening if you do make an over contribution? For example, in that past example we just looked over, you had made the $10,000 contribution and withdrew it. So in 2021, you would only have $18,000 worth of contribution room left for the calendar year. If you didn't fully understand that though, and you remade an $18,000 contribution, since you had already made a $10,000 contribution for the year and pulled it out, you only had $8,000 left. So if you recontributed $18,000, you would have an over contribution of $10,000. Hopefully that makes sense. And what ends up happening here? Well, that $10,000 is going to be subject to a 1% penalty per month for which you don't take care of this over contribution and, let's say, take it out of the account. 1% times $10,000, that can really add up quickly on a month-to-month basis, but that's pretty much what would happen. Okay, taking this into account, let's now move into part 2 of the fourth mistake, being trying to plan your TFSA contributions and withdrawals in more of a global tax strategy. Now, of course, this isn't going to be 100% concrete because things come up throughout the year, and well, sometimes you need liquidity that can definitely come from your TFSA. But let's say in early 2022, you know that you want to purchase a house or a vacation home or whatever, and you're going to need some money from your TFSA. Well, what would make most sense here is that instead of taking that money out in 2022, let's say in early 2022, where then that money cannot be recontributed for the calendar year, that entire rest of 2022 until the new year rolls around, it would be more wise to take that money out in the end of 2021 so that as soon as 2022 rolls around, which might be a month or two later, you're able to recontribute those funds if you have them available to your TFSA for taking advantage of that tax-free growth in the entire calendar year. And this is actually something that I did recently with my own TFSA, where I did some renovations around the house. I needed some liquidities on the personal level to do those renovations, which can really add up quickly. Well, what ended up happening is this wasn't 100% calculated on my end, but this is what ended up happening. Because I just did them in November, well, I took out around $5,000, but I'm going to be able to recontribute that $5K in a month once January 1st rolls around. So this is something that you can try to plan out if you do know you're going to make some larger expenses throughout your year. All right, and then moving into the fifth and last mistake here to avoid in your TFSA for 2022, it is going to be understanding how contribution room can be gained and can be lost. I have spoken about that previously in a TFSA video, but there was still some confusion around the topic, so I'm going to try and make it as simple as possible here. So basically, even though you have a cumulative contribution room that you are incurring and growing each year that you are above 18 years old, well, this cumulative room can also be lost as well as gained based on the actions that you take within your account, as well as the growth of your investments and the funds held within the account on a positive as well as negative level. So let's dig into this a bit more right now. So to better understand why this is, let's take a quick look at the formula for total contribution room in a TFSA. So it goes as follows. It starts with the old room plus the new room for the calendar year plus previous withdrawals equals your total TFSA contribution room. So with this in mind, we can better understand why and how you can gain as well as lose contribution room in your TFSA. So let's look at a first example here. Let's say your contribution room was $24,000 as of 2022 for those 4 years of $6,000 contributions per year. All right, so it's $24,000, and in this time you make a full contribution of $24,000 into certain investments that go really well and they grow up to an account value of $50,000. And then you say, well, I want to purchase a home once again and put that $50K towards a down payment. So you sell everything in your TFSA, you have $50,000 in cash, and then you withdraw the entire $50,000 from your TFSA. Well, now come the next calendar year, your contribution room isn't going to be $24,000 plus the new contribution room for the upcoming year, which will probably be $6K, so a total of $30K. No, your contribution room would actually be your entire $50,000 that your account had grown to and that you withdrew, plus the new probably $6,000 in the new calendar year. So your new contribution room would actually be $56,000 in this example. By the way, if this seems complicated and you have any questions, make sure to comment down below and I will try to answer as best as I can. Now on the flip side here, to better understand how you can lose contribution room, let's say you had that same $24,000 contribution room to which you made a full $24,000 contribution. And during the year, well, your investments didn't pan out too well, and for some reason they went down to $12,000 of value. So right now your TFSA's value is $12,000. Now you did not necessarily lose $12,000 worth of contribution room if you do not withdraw the $12K that you have left. However, okay, come the next year, you'll have a new, let's say, $6,000 contribution that you can make. However, that $12,000 balance you have right now, you can't make another $12,000 contribution to bring it back up to $24,000. Okay, if you have $12,000 from bad investments as an actual account balance, you can try to grow that back up to $24,000 or exceed it even and regain contribution room. But if you did lose 50% of the value in this case and you withdrew the $12,000, well, come the next calendar year, it's going to be $12,000 plus $6,000 is your new total contribution room moving forward. Again, if this seems somewhat complicated and you have any questions about this, comment down below and I'll answer as best as I can. So in reality though, mistake number 5 here, yes, you understand how you can gain as well as lose contribution room, but the real mistake would be, in my view, to invest into individual stocks exclusively in the tax-free savings account that are high-risk stocks that you don't necessarily fully understand the business model and you're just investing in them for no reason. We speak about individual stocks all the time on the channel. I love researching new companies, speaking about companies, potential investment opportunities, etc. But I also speak all the time about why I like exchange traded funds that cover broad market indexes, that have low fees and consistent returns over time. And I also speak about how I often have my portfolio up to even 50% of the entire weight and value in these broad market index funds. I'll leave a video right here that you can click on to learn more about exchange traded funds as well as what I consider to be core ETFs for a portfolio. But this is really the mistake in my view, would be to make full contribution towards your tax-free savings account, but then putting all of that money into high-risk individual stocks that you don't really fully understand without utilizing any form of exchange traded fund for those more consistent returns over time, and crafting a portfolio that's really suitable for your needs as an investor. So the tax-free savings account, absolutely fantastic account to utilize as a Canadian for that tax sheltering growth of your funds, as well as your interest and dividend income that you incur within the account over time. It's one of my favorite accounts, and usually this is the account that most new investors start investing with. So hopefully this video gave you a really good idea of, first of all, how it works, as well as the contribution room, and then also 5 mistakes to avoid if you're starting to invest in a TFSA in 2022, or even if you've started investing. These are also great things to consider. If you enjoyed the video, make sure to smash the like button. It really helps my channel out. And we also have multiple other videos on the channel about stock market investing basics that I'd highly recommend you check out. If you do want to learn more about stock market investing, make sure you subscribe to the channel, hit the bell button to be notified of new and upcoming content. And if you want to take your investing really to that next level and fully understand how to invest in the stock market, I'd highly encourage you to check out the links down below, as well as the link to my full stock market investing course. That's really, you're going to learn how to invest properly utilizing, let's say, a TFSA, and then utilizing also individual stocks, but also exchange traded funds for a portfolio that really meets your risk tolerance as well as your needs as an investor. So on that note, thanks a lot for watching today's video, and I will see you in the next one.